What's up, apes? Welcome back to the Daily Peels podcast / video stream of the day. My name is David. It is currently 7:58 p.m. on this beautiful Thursday, June 27, 2024. We are talking everything markets related going into the last trading day of the quarter. Time is absolutely flying by this year. I can't believe that we're about to be in July, personally. Down here in the South, it is way too fucking hot this time of year, but the market's certainly getting even hotter. I mean, the NASDAQ is up almost 20% for the year so far, and we're not even done with the first half. Meanwhile, the S&P 500 is up a solid 15.something%, and the WSO Alpha portfolio in the meantime has risen about 11%, 10.77% to be exact, after our 38 basis point rise here during the session today. Now, 38 basis points might not sound like a whole lot, but it is exactly 8 basis points higher than the NASDAQ rose today at just 30 basis points, and the S&P 500 was up just a measly little 9 basis points. Now, we feel a little bit bad for them. They're, the new guys on the block, the S&P 500. They're just trying out some new strategies and everything. So we don't blame them for performing poorly. They can give us a call anytime they want some help with portfolio management or anything else like that. But nonetheless, make sure to go sign up for WSO Alpha if you want to stay in tune with all of our trades, research, thought process, whatever other nonsense is going on with our team over here. All right, let's get into some of the banana bits here for the session today. First and foremost, the Federal Reserve. This is what we're going to be talking about on Monday as well in our Thought Banana, but the Federal Reserve ran its annual stress test of the 31 largest banks in the United States. Every single one of them passed, as they pretty much always do. I'm sure there's some kind of a way to game the system, but they did ultimately determine that these banks are prepared to handle losses in the range of $685 billion and still be able to make loans to individual small businesses. So, according to the Federal Reserve, these banks are in a pretty good position. They said the exact same thing in, 2006, 2007. So we are going to take that with a grain of salt, but still it's better than the opposite would have been. So, we'll take what we can get. Anyway, listings are up, prices are down. The housing market could finally be healing just a little bit. Listings have risen 35% during this month, and we saw prices fall just a little bit with the new home sales report. So it's moving in the right direction for home buyers finally for once. Levi Strauss got absolutely hammered on Thursday, and I'm not talking about in the good way like you and your friends probably did last night. They unfortunately lost a shit ton of shareholder value. So, we wouldn't know what losing shareholder value is over here at Wall Street Oasis, but still Levi Strauss managed to pull it off on the day. They had a very tough earnings recall, just very bad seeing. I guess nobody's buying jeans these days, and I actually don't own a single pair of jeans, so I can't blame anybody for not buying that shit. It is incredibly uncomfortable. All right, moving into our last banana bit of the day. The Supreme Court just told the Sackler family to go fuck themselves. Basically, they came out here. There was some kind of the settlement for the Sackler family and their Addicting of America went to the Supreme Court here today. Effectively, what happened was a certain group of victims in the class action suit from all the families who lost their loved ones because of these absolute scumbags. The Supreme Court basically came and said that the reward that they were getting, the decision, whatever monetary benefit, I'm blanking on the term right now, whatever monetary benefit they were supposed to get, they wouldn't actually be able to be issued because a certain amount of people in this class action suit didn't want to accept it. So basically, the ultimate determination of this ruling is that companies can't or are going to have a much harder time using bankruptcy to avoid civil liability. So the original deal was that if Purdue gave like $6 billion in total to the victims, then the executives, the people who played a role in this, wouldn't be subject to criminal and civil proceedings of their own. So they wouldn't have to pay money out of their own pockets, and they wouldn't have to potentially face prison time. And basically the Supreme Court said, fuck that. Let's take these people to trial. Let's see what happens going forward. So that's the ultimate. That's it for Banana Bits for the session here today. That's going to be a very interesting case to watch going forward. I really wish Purdue was a publicly traded company because then we could have, seen actually in its financial statements how bad this really was. But nonetheless, I'll stick with bankrupting the most evil family in the United States. That's, I guess, a good starting point for us here at the Daily Peel. All right, let's go ahead and get into the macro monkey of the day. We are talking about the good news, bad news GDP report. Now, really, there wasn't much news out of here, to be honest, but it's a good thing to be aware of, at least heading into the next quarter. Basically, what happened was the Bureau of Economic Analysis, they finally issued their third and final estimate of GDP growth in the first quarter of 2024. So they do this 3 different times, and it's basically just each month after the initial quarter. So I know we're done with the second quarter, but counting is hard, and it takes the government a little while to catch up, apparently. So they finally came out with their final estimate, and what did it look like? Well, go ahead and take a look at this chart right here. doesn't look any different than the last estimate did. It's actually changed by about 1 basis point because the original or the second estimate stated that GDP grew 1.3% in the first quarter of 2024, when in fact it actually grew 1.4%. So barely any difference whatsoever. I think the real important thing about this graph that we're seeing here is that it's only 2 quarters away from looking like a normal GDP growth graph once again. Those are, of course, the second and third quarter of 2020 when I don't know what was going on. Did something happen in spring of 2020 that bled over into the summer and every year since then and ruined my college experience? I don't really remember, to be honest, but I'm just excited to have this stuff off this graph because then it can go back and we can actually see the differences in these things. But nonetheless, that's the real news here. So what caused it? What caused the actual uptick? Well, that's explained by this graph that we can kind of read at least a little bit. So it turns out that basically the changes that they missed in the second estimate that they updated in this third estimate on the detracting side was that imports were actually higher than we thought and consumer spending was actually worse than we thought. So imports being higher, imports get subtracted against exports going into the GDP calculation. So that rose, bringing down the total figure for net exports and ultimately brought down the total GDP reading for the quarter. Now, at the same time, that's not necessarily reflected in this chart, but what this is showing is the changes in different industries. So within the GDP equation, you have consumer spending, you have industry investment, you have government spending, and you have net exports, which I already mentioned. This is showing you the industry investment chart. And so it says that the only decliner was private goods, and we'll see why in the next chart that we talk about here. Meanwhile, private services and obviously government spending was up. That will literally never be negative, to be quite honest with you, especially with the way that interest payments are going. But it was really just the private goods sector. And when we're even talking about private goods, it's very specific into what was bringing it down. So these are all of the sectors of the economy that the BEA very broadly identifies. And as we can see here, everything in the yellow is private services and in the blue is private goods. If you look at how this chart breaks down, it's mostly the private services that are doing well. Services are most of consumer spending in the United States, so it's not super concerning here. Now, construction, by the way, is the private good up here. So shout out to my dad, who's a carpenter, for supporting the entire economy. God, he's going to love that when he watches this. But anyway, the ones down here at the bottom, these are primarily goods, and it is specifically durable goods and non-durable goods manufacturing. So the manufacturing sector is definitely not doing well. Interest rates have a, huge thing to do with that. And it's also demand driven because it seems like these days consumers obviously are price sensitive to a certain degree with inflation. There's different elasticity across different demand spectrums depending on what product you're exactly talking about. But for durable goods specifically, these have been hit hard by inflation. It's, if people think that there's any chance that we're going into a recession or otherwise hard economic times, they are going to put off these big purchases for things like a new refrigerator or a new car as long as they possibly can. So it's not much of a surprise to see durable goods down that much. Non-durable goods, again, it's typically not essential things that people are going to be purchasing here. You wouldn't necessarily see this with like foodstuffs, or like anything like that. But up top, leading the way, we have retail trade, construction, and of course, the apes themselves, finance and insurance. So in addition to my dad, shout out to all of you guys working in finance and insurance for carrying the entire team. Now, the bad news of this report, of course, it was the good news, bad news GDP report, comes in this graph right here, because along with the GDP report, they give us the latest update on PCE inflation on a quarterly basis, which isn't what the Fed follows, but certainly caused J-Pow to raise an eyes yesterday because we just saw the highest quarterly inflation that we've seen since the first quarter of last year. We have known this for quite a bit, by the way, but it did get upticked in the estimate as well. So originally in the second estimate, it was 3.3% is what we thought inflation was at. It was actually 3.4%. So again, the change itself isn't a huge surprise, and the markets already had this priced in. So, this was the first quarter of this year. So we're not talking about the last couple of months. We're talking about January, February, and March, when inflation was still relatively high on both the CPI and a PCE basis. Not that it's not high right now, but it's kind of in like crybaby territory where it's not like that big of a deal anymore. But cumulative inflation is definitely going to be a problem that people complain about for quite a while. So overall, good news, bad news. It wasn't really anything huge. It did, real GDP came in much slower than expected, much lower than Q4 of 23, which is still the real news from this story. But again, that's nothing groundbreaking. It's something that we've known for quite a while. And this is kind of adding fodder to the argument for cutting interest rates sooner rather than later, the lower for sooner argument that we pioneered here at the Daily Appeal, to be quite honest with you. But it didn't change anything for interest rate expectations. Treasury yields declined a little bit in the morning session, but it wasn't really anything material. Certainly not worth putting a graphic in. So with all of that said, let's go on into our big stock movers of the session. First and foremost, we have National Beverage Corp, which is one of my favorite tickers of all time. It is Fizz, and that's the only thing I like about this company, because this is one of those companies that makes products that are strictly for douchebags. You know, LaCroix water, Everfresh, whatever the fuck it is. I don't know if it's water, but it's basically a product that makes goods for people who think that they're better than you. That's the only way that I can describe this company's target audience. Either way, they're doing a damn good job. It's a good business strategy, because the stock was up 15% for the session today. And that was because the company came in with a very strong earnings report. They showed 20% growth in net income year over year. Volumes grew 5% and prices grew as well, just because of inflation. So sales were moving in the right direction. Overall, it was great. I guess having a consumer base of a bunch of wannabe wealthy consumers is a good way to go, because they'll spend money to flex. So shout out to National Beverage Corp. Meanwhile, moving on into RH, formerly known as Restoration Hardware, which I think that should still be its name to this day, but either way, this stock was up 9.2% for the session on Thursday, not necessarily because of anything that the company did, but because the CEO is putting the entire fucking team on his back. So, Marsh Carter, a famous investor, once said that a rising stock price isn't a good business strategy. A good business strategy will increase your stock price. But RH low-key proved him wrong here today, because all they did was make the stock price go higher, because Mr. Gary Friedman, the company's CEO, put another $10 million of his own personal wealth into the stock. There's only one reason why insiders buy stock in their own company. There's a bunch of reasons why they sell. Liquidity events, they need money too, believe it or not. But there's only one reason that they buy, and that's because they think the stock is going to go up more than the general market itself. Obviously, investors love that vote of confidence. All right, moving on down below, Walgreens Boots Alliance. Somebody play tap. Say a quick prayer for this company, because they fucking died today. The stock was down 22.2% for the session. Its worst day in over half a century, and actually the lowest price that it's been at for this current century. So the stock closed at around $12.70, which is its lowest price that it's ever closed at since 1997. So it didn't get this low during the GFC, didn't get this low during COVID, didn't fall this much during the GFC, didn't fall this much during COVID after 9/11. Literally anything that's happened in the past 50 years, it did not fall this much, but it did because of the earnings report that it released yesterday. And basically, what they came out and said was, we are fucked. So that's how I can translate from Wall Street jargon into Main Street jargon. That's essentially what the company said. So they missed on earnings. I forget if sales beat, and I didn't write it down here. I'm going to go ahead and assume that it didn't because of how bad this was, but they missed wide on earnings, and the real detrimental part was that they are going to be closing a bunch of stores. Now, the CEO used the term significant amount of stores, and he also provided some detail saying that 75% of our stores drive 100% of our profitability. So there's going to be a bunch of locations that close down. I say fuck Walgreens. This is one of my least favorite companies in the country for very personal reasons, and also for the fact that, little piece of news here. There is the town that I grew up in is called Whitman, Massachusetts. Very small town, but the chocolate chip cookie was invented in Whitman, Massachusetts. Ruth Wakefield founded the Toll House Company, purchased by Nestle. You can look this all up. It is absolutely factual. And there is a parking lot in between a Wendy's and a Walgreens where the old Toll House building used to be. It is obviously no longer there anymore because late-stage capitalism has taken over. But you can still see the Toll House sign. It's there, so it's pretty cool. So, Walgreens taking up the sacred land that is the founding of the chocolate chip cookie, is absolutely disgusting to me. So fuck Walgreens. I absolutely love to see it. Anyway, let's move on into our last stock move of the day. We have Micron down 7.1%. This is a chip company. They specialize in making chips that are specialized for storage and memory. So a lot of people think that they are not going to be part of the AI training wave, but the AI inference wave. So it's a big play right there. Today could certainly be a buying opportunity, but they did fall because of earnings. Now they beat across the board, but guidance came in line with expectations, and the market absolutely hated it. It just shows you how brittle these semiconductor companies are. There's very little margin for error that even coming in line with expectations is reason to sell the stock. There could be some profit taking going on here, but it also could be a buying opportunity. Let me know what you guys think down in the comments. All right, finally, we are talking about poverty and private equity. I know it sounds like an oxymoron, but compared to private credit, it is absolutely true. Go ahead and take a look at this chart for me right here. What do you think this is? So the red lines are returns in private equity for each given year. The blue line are returns in private credit for each given year. So back in 2020, they absolutely dominated. It was completely fucking ridiculous. We're up 30%, up 40%. But in 2022, 23, and 2024, private credit is running them out of town. So it's really just an interest rate story that we have right here. But the important thing to keep in mind is that private equity recruiting just began. So it's probably going to be an even tougher season than usual right now, because finding an exit is like finding, it's basically impossible right now to find any kind of desirable exit for these companies. And that's why you see the returns as being so low. And if we actually look at just the timeline since 2022, let's go ahead and skip to that chart real quick. We can see that private debt has absolutely dominated. So still it's at about 15 or so percent, whereas private equity is down like 2.5. If we go back to this chart and we do their returns since 2019, private equity is absolutely still dominating. Don't get me wrong. It's not like they're being completely trounced in the long run, but over the past couple of years, that's what makes this story worthwhile talking about. The basic line is, when interest rates are high, it's harder to get buyout loans for these other private equity companies or for whoever they're going to be selling to. So it's more difficult to get banks to finance that amount of money. Whereas in private credit, it actually helps because you can exponentially slap on higher rates, meaning that if the Fed raises rates by 25 basis points, these companies, they don't have to raise by 25 basis points. They can raise by a full % if they want to, and it'll probably still work out. And at least that's what's been demonstrated here over the past couple of years. Make sure to go ahead and sign up for WSO's private equity course as well if you were looking to break into the industry. We want to make sure you help out. We want to make sure you get there, and you're not one of these people who's, completely fucked like these charts represent. Anyway, guys, that about does it here for us today. Let's go ahead and finish off with a quote on private equity from one of my personal favorite authors, Mr. 𝗪𝗪𝗀. He came out here, the private equity guys are not going to like this one, but he came out and said, private equity has absolutely no reason to exist. The private equity holder has all the upside and the banks all the downside. So there's no skin in the game. That's a problem with private equity, but clearly it hasn't affected returns too much. It's just affected single mothers who BlackRock is evicting from their houses. I'm just kidding. That's clearly an exaggeration. That stuff has been debunked time and time again. I'm happy to debunk it in the Daily Peel as well if anybody wants me to. So definitely hit my line, let me know. But otherwise, I'm going to call it for the day. It's 8:15 p.m. Thank you guys for tuning in once again. Happy investing, happy trading, and bye now.